One of the best segments of the market, a group of stocks that has beaten the market by 88% over 2 decades, is almost completely ignored by most investors. In this video, I'll show you why small cap stocks need to be a part of your portfolio and how to find the best. I'll then reveal 3 small cap stock picks that I'm buying in June in one of my favorite stock sectors. We're talking small cap stocks to buy today on Let's Talk Money. Hey Bowtienation, Joseph Hogue here with the Let's Talk Money channel, and I know I say it every single video, but I gotta send a special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, we uncovered some big gaps in our 2021 Bowtienation portfolio when we did that review 2 weeks ago. Almost a third of the portfolio, 28%, is in healthcare stocks, and we've overweight in financials, energy, and communication services. And while I like all 4 of these sectors, we've got almost nothing in 2 of my favorite sectors for the year, stocks of industrials and basic materials companies. After positioning early in stocks of financial and energy companies, the portfolio is up 37% so far and beating the market by 26% this year. But now I think stocks in the industrials and the materials sector could be the next to really take off. Both benefit from that moderate inflation and the kind of economic growth that we're starting to see. So I wanted to use this June video to fill in those gaps, add 3 stocks to the portfolio, but not just for the sake of getting stocks in those sectors. I want to find 3 stocks with not only that sector upside, but also the potential for even higher returns. In this video, I'll show you why small cap stocks need to be a part of your portfolio and why they beat the market return. I'll give you a step-by-step to finding the best small cap stocks to buy, and then reveal the 3 small stocks I'm buying right now. We won't be doing a review of the portfolio this month because I want to get to those small cap stock picks, but I will leave a link to Stock Card in the video description below. Click through and then go to Portfolios in the top menu. You'll find the Bowtienation portfolio in this stock picks section. It's free to follow and you'll get email notifications whenever I buy or sell from the portfolio, even before these videos. And as a special bonus, I've negotiated an exclusive discount for everyone out there in the community. Use the promo code BOWTIENATION, all one word in lowercase, for an exclusive discount beyond the free trial. First up in our small cap stocks list is Nexa Resources, ticker NEXA, a $1.3 billion zinc miner with assets across Latin America. Now, Nexa is the largest of the small cap stocks that we'll look at, but still very much a small miner compared to like $62 billion Freeport-McMoRan. Still, the company is the 5th largest zinc producer, with mines in Peru and Brazil producing over 500,000 tons in the first quarter. While zinc might not get the attention of copper or gold out there in the markets, it's a key component in construction and automotive, 2 industries with great near-term growth. About 170,000 tons of zinc is also needed each year in those renewable energy products as well, so lots of growth and demand. The company has a strong pipeline of developmental mines as well, helping it to keep up production growth as prices head higher. About 2/3 of production is from zinc and another 16% from copper and 13% in silver mining, and like almost all commodities, these have seen prices take off over the last year. Zinc is up over 108% since the beginning of 2020, and the price of copper is up 161%. The company has a strategic advantage in its smelting operations, with 52% of that source input from its own mines, so it's got a strong vertically integrated position. The company reported 36% year-over-year revenue growth last quarter to $603 million, though the COVID closures did hurt it last year. It's getting back on track though and still booked $2.1 billion in sales over the last year. The balance sheet is a little shakier here than what I usually like to see in these small cap stocks. Now, Nexa has $1 billion in balance sheet cash against $1.9 billion in debt, but there is no major debt maturities until 2027, and it's a cash flow business. There's plenty of assets here and the financial flexibility, so I'm not too worried about that debt. And besides its position in that materials sector, and again, I love this sector for this year and next, the valuation on this stock is insanely low. Shares trade for just 0.63 times sales versus an average for the mining industry of 3.1 on a price to sales basis. Now, that lower valuation is mostly due to its mines in Peru and Brazil, and those countries being so far behind most other countries in dealing with the pandemic. But they are starting to turn it around, and when that happens, a lot of value gets unlocked from these shares. Now, Nexa is actually on the high side of what we usually consider a small cap stock, but there are some real opportunities in these smaller companies. So I want to explain what these are and how they tend to beat the market. When we talk about small cap stocks, we're usually talking about the company's market size. It's market capitalization. Market capitalization is the total market value of the shares. So it's the share price times all the shares available, and investors usually think of this in four sizes. Mega cap companies are those worth more than $300 billion. So you've got those huge companies like trillion-dollar Apple and Facebook. Large cap companies are pretty big too, though, with a size from 20 billion to 300 billion. Then you've got the mid caps, which are generally between 2 billion to 20 billion, and then the small cap stocks from 300 million to $2 billion in market cap. So small cap companies aren't quite as risky as some of the penny stocks that we cover here on the channel, but still small enough for more flexibility versus their larger established players. They've grown large enough to find that segment of the market that they can focus on and serve its customers better. And that's what makes these such a great investment. And small cap companies can focus on a specific niche of the market, so a segment of the whole, and then serve those customers better than a larger company serving the entire market. And some of this is just the law of large numbers. A large $20 billion company with $5 billion in sales, it needs to target every part of the market. But a smaller company that's only building from a base of maybe 500 million in sales, it can focus on that niche segment to take share away from the bigger rival. It might only be able to grab another maybe $100 million in sales, but that's still a 20% growth versus the bigger company that would have to increase its sales by $1 billion to see that same level of growth. And the proof is in the returns. The Russell 2000 index of small cap stocks has beaten the S&P 500 by 88% over the past 2 decades. There are periods of underperformance. Small cap stocks tend to do worse in a recession or a crash, so you see that gap narrow in the chart from 2008 and 2020. But over time, small caps build on that outperformance for higher returns. Next on our small caps list is PAE Incorporated, ticker PAE, a $773 million provider of operational and outsourcing services primarily to the U.S. government. Now the chart here is a little busy, but it does give us a great overview of the company. The light blue ring here shows you the 5 segments in which the company operates, from intelligence and technology services to business processes, logistics, and engineering. The next 2 rings are the 2020 and 2021 revenue mix for each. So we see about 50% of the revenues come from that infrastructure and engineering and the mission readiness segments. Finally, the outer ring shows the margin profitability on each segment. So a little lower margin on the 2 biggest segments, but stronger profitability on others, and that's actually where the growth is as well. Now, the company recently confirmed its 2021 guidance for $3.1 billion in sales and $120 million in operating cash flow. And now for a $773 million company, a company that small, to be producing over $3 billion in sales is very rare. PAE has a project backlog of $7.9 billion and is renewing 93% of its contracts with the government when those are completed. So it's got a strong outlook for future revenue. The company is also improving its profitability, improving that earnings margin by 0.6% last year to 6.6%, with a long-term target of 8% margin. That $3 billion revenue target would be 14% growth from last year and means the shares are trading for just 0.25 times on a price-to-sales basis. And that is half the average price multiple on the closest comparables, like Vectrus, which is ticker VEC, which trades for 0.4 times sales, and ACOM, ticker ACM, which trades for 0.7 times sales. In fact, this stock could come up 40% and still be a better value from those 2 closest competitors. We've still got the smallest of the 3 stocks to highlight, but I want to give you those 3 steps to finding the best small cap stocks. 3 factors to watch for picking these stocks. First is you're looking for companies that are growing their revenue year after year, and not just that total sales, but also cash flows. You'll find revenue reported on the income statement and can look at the statement of cash flows for that trend in operating cash flow. This is really where it has to start, right? The smaller companies aren't coming into virgin product markets. They're competing against big established players. If that small company can't develop some kind of advantage that comes through in higher sales, then it's sunk before it gets out of the bay. I also like to see improvements on profitability, specifically that each year the operating profit margin gets a little higher. Remember that operating margin is just the operating income, so what's left over of sales after paying all the business expenses, that divided by sales. So not only do you want to see a company growing its sales, but you want to see that it's getting more efficient, more profitable doing it. Put these two together, and that company is going to be on the path for higher earnings and returns. Finally, here for small companies, I want to look into its financial reports and find the addressable market and some kind of a competitive advantage. Now, this one is more subjective, and it's going to take a little more research. But what I'm looking for here is the management's plan for competing against those big established players. I want to hear that the company is targeting a smaller segment of the market for that product, and that it has a plan for how it's going to beat the big dogs in that segment. Now, what I don't want to see here is a smaller company just trying to compete against Goliath and serve the entire market. Most small companies just don't have the financial strength to do that. It's just not going to happen. The smallest of our small cap stocks I'm buying, US Express Enterprises, ticker USX. The company is the 5th largest asset-based truckload carrier in the United States, with over 6,000 tractors and 13,000 trailers and a terminal network across the country. Now, the entire trucking industry should have a really good year on the rebound in retail sales and consumer spending if it can just fix its driver shortage. That's actually why USX is one of the most interesting stocks I've seen in a long time. The company's Variant program is an app-based model using AI on a digital platform to revolutionize trucking. It's like an Uber for truckers. The program expanded to 951 trucks last quarter and is on pace to hit its target of 1,500 by the end of the year. The program has already driven 26% higher miles per week from drivers and a 61% improvement in driver turnover, which in that years-long driver shortage is a game changer. The acquisition of Transportation Data Services last month builds on its cloud software tools to further increase that productivity, and I love that the company is at the forefront of implementing tech solutions in trucking. Sales were up only 6% last quarter, but operating income jumped, and the company returned to net profitability against a tough 2020. Analysts expect USX to report $1.9 billion in sales this year and 99 cents a share in earnings. That puts the shares at just 0.28 times on a sales basis and 10.7 times on a price to earnings basis. It's a third the multiple you find on shares of Schneider National on a sales basis and half the PE ratio. Now, it seems like that discount in valuation is just on the uncertainty around the Variant rollout, but if the company can execute on that program, it could revolutionize trucking, and this could be a $20 or a $30 stock by the end of the year. Click on the video to the right for the 5 genomic stocks to watch for one of the biggest trends over the next decade. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.